Hi, I'm Seema Gohil, the Director of DigiFarm, Safaricom's digital agriculture platform.
My name is Jared Uchin. I work for the financial sector deepening Kenya. Currently, I serve as the Senior Agriculture Specialist.
My name is Ugochi Izora. I'm the Head of Operations for Livestock 247 Services Limited, based in Lagos, Nigeria.
My name is Pius Sige. I'm the founder and the CEO of Amtech Technologies Limited.
My name is Penina Wanja. I'm the founder and MD, DigiCow Africa Limited.
Some of the key factors to consider for partnerships with financial institutions is first just understanding the risk profile and ensuring that you both have the same risk profile and willing to take the risks. Some of the other things to consider is also timelines. Are you on the same wavelength in terms of timelines? How quickly both parties can move? Approval processes, so sometimes you might find with financial institutions, they might actually have more processes in place versus some of the agro-producers or agri-tech companies that we're typically used to seeing.
When developing a partnership between financial institutions and agro-dealers, we'll include the values of the agro-dealers and their visions. That one is going to be very critical. The second factor that we are going to consider is the sustainability and profitability of the agro-dealers. The third factor is the credit scoring for the agro-dealers, because this is very important so that you do not underfinance or overfinance. We are also going to consider the revenue streams and when they come, and also a consideration of the crop and livestock production cycle will be very critical.
So some of the very important key factors, one is they look at the risk, the agricultural credit risk, because in Kenya, we are relying on rain-fed instead of like irrigation. So everybody is saying, if I put in money here, the risk is very high. That's number one. Number two, they look at the lending rates. So the higher the lending rates, the farmers will shun that particular product completely. And then number three is the size of the loan that you are looking at. So it's very important to know the size of the loan that you want from the financial institution. And then finally, the type of financial institutions. You can go to a certain bank and the bank will tell you, our rate is this one and we can negotiate. Then some will tell you, please come to the table, and then we talk about it, and then we shall be able to come to, we make addition on that, and then we agree.
You want a financial institution or a partner actually that is flexible, that can understand your vision, that can really provide, that can understand what you want to do and can go with you on the journey. Because in preferring this solution and in actual deployment of the solution, there might be some changes, there might be some issues that you encounter. So you want someone that is flexible, you want a partner that is flexible, that can give you the leeway and understand that, okay, you have, there is a partnership, they can leverage on your knowledge, and then you need them to do something when you need them to do something. So I think flexibility is key.
The first thing that you need to do is to start early negotiation. You don't need to go like today and say, I need this kind of facility and you need it like next week. So start early negotiation. Number two, know the type of products that the farmers or the agro-processors requires. So if you are dealing with specific value chain like dairy, you know which facility you need, and it has to be as soon as possible. Then number three is that is the innovation of the particular institution that is available. If you don't have innovative solutions, nobody will want you to in that partnership.
The leverage points that exist in moving solutions forward with financial institutions, I think, are really bringing together public and private partnerships, specifically catalytic capital. I think banks and financial institutions typically, again, have like a higher risk threshold. And so bringing de-risking mechanisms into play have really helped us break through and move solutions forward. And I think it's brought both sides to the table and given comfort to both sides.
So the leverage points that are required to move solution forward is to be very, very innovative. Specifically, making sure that whatever you have for the farmer can be able to add value to that particular farmer. Because let's say, for example, Amtech having a credit scoring solution. So what are we supposed to leverage on? Basically, we need to leverage on the information the farmer we have by including even the farm level data. The farm level data means making sure that I know the number of acres the farmer has, the number of produce that you want to produce, and at what point will you get the money so that I get my money back, and also including the interest.
Some of those challenges that we've experienced, especially in this partnership discussion and/or collaboration, is where the definition of what the project is supposed to do is not well discussed among partners from the get-go. Then you have misalignment of incentives that creeps up from the beginning that should probably have been addressed. And then number two, the pieces not necessarily fit in well from the get-go. And usually when the pieces do not fit in from the get-go, then you are carrying over something that from the word go never fit, the pieces never fit, and then you never discussed, as I mentioned earlier, an exit. In terms of how then we surmounted some of those challenges was, one is to have a conversation where you're bringing all these actors to harmonize that discussion, the discourse that was missed prior. And of course, there's a need to level expectations better.
The primary one is really data and how to really share data in a way that you're respecting GDPR laws, but also allowing for both sides to co-create. So I think data sharing continues to be one of the biggest obstacles because we do really have to protect customers' identities, but also allow for innovation. So the other thing is risk appetite. Similarly, I think agri and investing in agri solutions tend to be seen as more risky. And bringing partners to the table, especially financial institutions, can sometimes be trickier because they don't have the same risk appetite. In terms of timing, it's hard to say that a single partnership unraveled at any specific point. I think different partnerships have had different challenges, some at the outset, and I think those are obvious ones that didn't continue. But we've also had partnerships that didn't work out post-implementation. And I think lessons learned from that is ensuring that, from the outset, you both have very clear goals, objectives. Both sides also have the same commercial goals, and I think that's been one of the challenges.
What is very important is trust issues, because whenever you are coming in with other people together, the first thing is you make sure that there is a very good handshake, collaboration between the two. So if there is no trust issue, that is there is a problem. Then number two is a common bond. A common bond means whatever we have together, we shall be able to get something out of the process. So that one also is very, very important, because if you don't do that, you can't. Then the other thing is communication in between the actors.
The major challenge that we've experienced are organizational bottlenecks. So different organizations have different ways they do their things. So sometimes some of those systematic procedures or operational procedures, yes, can clash, and it can come in the way of implementation of your idea. Organizational procedures, rather, can either act as a catalyst for what you want to do, or actually kill the vision of what you want to do. So if you're not in line with the right partner, or you don't get all of those things out of the way, it's going to affect it.
The organizational culture between corporates and development partners, I think, is a really interesting question because I think the key difference is typically around timelines. What you tend to find on the corporate side is a little bit more of a, kind of push towards, like, not necessarily shorter term, but, kind of medium term, or we work on, like, 3, 6, 12-month type cycles sometimes. Whereas on development partners, we tend to see that more in terms of 3, 5, 10-year cycles. And I think that sometimes can be a bit of a challenge in terms of matching both. Also, processes tend to differ on both sides. You might find agri-techs, which are much smaller, may be able to move faster and be able to get through internal approvals and processes much faster, whereas you might find sometimes on the development side. Now, that tends to happen on both sides, right? So it's not one or the other, but I think sometimes you tend to find cultural differences, just in terms of, I think, timelines, time horizons specifically, right? I think a lot of times for commercial organizations, and even some of the startups, like we have shorter funding, we have shorter runways available.
We train our staff specifically to be able to handle societies and circles. The way you deal with a society or a circle is different from the way you deal with an individual, because a society has a board member. So if they don't get, or if they don't agree or consent on an item, you can't go anywhere. So we normally make sure that we have a culture whereby when you go to a cooperative, you make sure at least you have like 4 or 5 people accepting your idea.
For government, there is this, for each successive administration, there is a manifesto that they ascribe to, the results that they want to attain. Some of this change, of course, that's at the macro level in terms of policy shifts. And lastly, there is the agenda of the day that may not necessarily fit to what then you are looking at as a systemic approach to market development, so to speak, but then it's just addressing the issue of the day. And sometimes, fitting it all together then becomes a challenge. Public-private development partnerships, one, are integral to say how then we are going to measure our growth as a country using recognized standards. But then from the get-go, we need to sit down and we need to have a delineation between the needs and the wants. We need to understand the results delivery, what we intend to achieve at the end, and how to measure it in terms of whether it's an output, an outcome, or an impact. How then do we want that results delivery to go?
First and foremost, there needs to be a clear-cut vision cast. So definition of roles, definition of benefit, definition of entitlements, that needs to be done, stated, clearly stated, written. You can't afford to have any assumption. It will also go a long way if you have representatives.
I think something which is very important there is we make sure that the partnership between the institutions, AmTech, and even the government has to be very, very, very strong. Because if you don't agree with the banks, you will not get the investment. If you don't agree with the government, they will close your business. So it has to be like a 1-to-1 ratio.
The suggestions I have for successful partnership will include: 1, ensuring that you are well aligned in terms of your objectives and the vision and the direction. This will help you to avoid conflict. Second is to ensure that communication and transparency is adhered to so that you can foster trust. The third key factor would be to consider how risk is going to be shared and how risk will be mitigated between the partnering organization. Then we will also have a robust legal framework that is going to outline how the partners are going to partner, if there are costs involved, if there are profits, if there are other impacts that are needed to be achieved, that they are going to be fully achieved.